One of the first decisions you have to make when starting a business is choosing how you want to legally structure your business. This decision affects how much you're going to pay in taxes, how much risk you're exposing yourself and your family to, how you actually have to run and operate the business, and what paperwork you need to file. Yet it is really commonly overlooked. I can't tell you how many people I have talked with over the years who have been running and operating a successful business without ever exploring their options. Hi, my name is Sierra. I am founder and lead advisor at Infinite Heights Wealth Management, and we do a lot of our work with small businesses. And one of the most common tax saving strategies that I recommend is for businesses to consider filing as an S Corp. Now, a lot of businesses start out as a sole proprietor. A sole proprietor is by far the simplest and easiest form of business to set up. There is no separation between the business and you. 100% of the income that your business earns flows through to your personal income tax return, and there is no liability protection. If you were to ever be sued, the suer can come after you and your family's personal assets. So the next step up from that is an LLC, Limited Liability Corporation. It's creating some separation between your business and yourself, and it's giving you some protection. However, a common misconception that I hear is that people are choosing to file it as an LLC so that they can get tax savings. In fact, there's actually no difference between a sole proprietorship and an LLC when it comes to taxes. 100% of your business income flows through to your personal income, and 100% of the income is subject to self-employment tax. And that self-employment tax is 15.3%. An S Corp, on the other hand, requires you to pay yourself a payroll, and it's only that payroll salary that's subject to that 15.3%. So imagine your business is earning $100,000 and you chose to pay yourself a $50,000 salary. That $50,000 salary would be subject to the 15.3%, but the remaining $50,000 would not have that additional tax. So in this example, that math equates to $7,600 in tax savings per year. So this can add up and it can be a great tax saving strategy. There are some things you have to be aware of. You actually have to pay yourself a salary, and it has to be deemed as a reasonable and fair salary. So you want to do your research and you want to make sure you're paying yourself an appropriate amount. You also have to file quarterly payroll reports. So there's additional paperwork. There are some costs associated with payroll, but typically that tax savings by far wins out. A lot of people will think that they need to be at a point where they're making a lot more money before this makes sense. And the math typically works to the point where it makes sense for anybody who's earning at least $40,000 to $50,000 in income. So it's actually a pretty low bar. Another common misconception is that this tax saving strategy must subject themselves to more risk when it comes to audits. And actually, S Corps are 15 times less likely to be audited than a sole proprietorship or an LLC. Now, I get a lot of clients who own rental properties, who have Airbnbs. Rental income is not subject to self-employment tax anyway, so this strategy would not make sense for LLCs that just have property. There is a lot more to consider. Absolutely recommend working with your CPA, your attorney, and your advisor. We are here to help you make these decisions. There are a lot of factors to consider, and you want to make sure that this is the right choice for you and that it is going to give you a significant tax savings. But I find that a lot of businesses, small businesses just starting out, this is a great first step for them.